And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, the second best day of the week as we get ready to wrap up this trading week and also getting ready to head into the end of the month. End of the month right around the corner. Remember, February, 29 days. So they're just going to drag this month out as long as possible. I actually have a friend of mine, his son's getting married, right? And so they have now scheduled their wedding on February the 29th.
Sadie Hawkins Day.
Right. And so this is genius, though. And his part, he's only got to remember his anniversary once every 4 years.
Exactly.
So, now, the bad side is if you forget that, you're really in the doghouse.
Well, there's that,
right?
yeah.
So, anyway, this is kind of a genius idea.
No good deed goes unpunished.
February 29th. Only have to do anniversary once every 4 years. It's not our anniversary. Yeah. So, there you go. All right, so look, lots of stuff happening overnight, of course, as the world's most important company, Nvidia, reported earnings. Sales surged, had a big jump in revenue. In fact, they booked more revenue in one quarter than they did for an entire year. So, you know, it's just been going gangbusters for Nvidia, of course. That's also been driving the market. At $1.6 trillion in market cap, it's going to be worth more than that today. As the stock's going to open up about 15% at the open. It's going to take out, so it had this recent correction back to the 20-day moving average. Nice little entry point for the stock. Stock's going to open up above 770 this morning, right at 770. So it's going to take out this recent high, open up at new all-time highs this morning. Of course, that's also now pulling up the rest of the market with it. Futures this morning up sharply on the S&P, and NASDAQ's going to be up almost 2% this morning at the open. The S&P is going to be up about 1.5% at the open. So all of this kind of concern recently in the markets are getting resolved very quickly. And even though Nvidia and the market are on sell signals, not going to matter. We're going to be back near all-time highs on the S&P this morning when the market opens. Now, whether or not we stay there all day is going to be kind of a different story. But we'll come back and talk about this in a second when we talk about the markets. Real quick, the Federal Reserve out yesterday, and Mike and I will talk a little bit more about this morning. The FOMC minutes were out yesterday, and two things really kind of came out of that those minutes more than anything else. Is one is that the Fed is not in a rush to cut rates. So one of the things that we've talked about before, and one of the risks to the markets, at least near term, is this disconnect between the markets expecting numerous rate cuts this year versus what the Fed is saying. And again, I'll talk with Mike more in detail about what those minutes said. But the other interesting thing that came out of that was that about reducing the rate of quantitative tightening. So the Fed's concern is about the drop in reserves in the markets, and they're worried about the repo market in particular, where we have another 2019 event where they were having to really step in to help boost the repo market. But at the same time, we have a lot of liquidity coming into the markets. In fact, we've had a very strong rise in liquidity ever since last October, which has corresponded with this rise in the markets. And I posted a chart of this out on Twitter this morning. But when you see the amount of liquidity coming back into the markets, of course, this is why asset prices have been rising. You know, there's not really a concern of liquidity for the markets. It's just a question of liquidity for the repo market. So if the Fed is going to have to start reversing QT, what does that mean for the markets? And again, you know, one of the concerns that individuals have had is, you know, are we starting to replicate, particularly when you take a look at stocks like Nvidia in particular, and a lot of these other tech stocks that have just kind of gone to the moon here recently, are we repeating another type of bubble cycle in those Magnificent Seven that we've seen previously? And again, when we talk about Magnificent Seven, it shifts a little bit here and there. Tesla's out, Eli Lilly's in, but you get the point. Are we seeing kind of a repeat of some of these more bubble type attitudes in the markets, and this idea with market and market behavior in general, that stocks can only go in one direction, and that's higher? So here's what you need to know before the bell. We'll get into all that, but here's what you need to know before the bell this morning. So markets came down again yesterday. We sold off during the day, came down and retested that 20-day moving average again. So again, this primary trend line of the market since the October lows. And remember, back in October last year, everybody was concerned that, you know, we're going back into a bear market. We're having this correction during the summer. We were down 10%. Very, lots of concerns about where things were headed. Then, of course, in November, we started this rally, and that also corresponded with the increase in liquidity. And since then, the 20-day moving average has continued to be the primary trend line to support this bull rally. Every time we've come down and tested this 20-day moving average, it continues to hold. Now, that confirms that the bull market is still intact, at least for the moment. And so yesterday came down, tested again. We actually tested it for the last 2 days, bounced off of it both days, have turned up. And this morning, because of Nvidia's earnings yesterday, we're going to have a big jump this morning, and markets are going to be back up at this previous top. So, again, so two things going on here. We still have this consolidation going on in the market. So markets really haven't gone anywhere now for a couple of weeks. We've just been trading up and down, but we're compressing that consolidation. So if the market does break out of this little consolidation, we're going to continue to move higher near term. And again, there's all indications of that. The only concerns are, and again have been, is that we continue to run at a fairly elevated rate in terms of the market. So in other words, when we take a look at the market overbought, oversold conditions, we're still pretty overbought. We do have a sell signal in place that'll probably reverse today. We'll see what happens today or tomorrow. If this market follows through, we'll reverse that sell signal again. That's not uncommon in markets where we are right now with a lot of bullish sentiment behind it. These markets can stay overbought for a fairly long time. The one thing we've got going on, though, of course, is this overbought condition of relative strength. That's been declining. So we've actually had this negative divergence between the markets and relative strength. So we need to see relative strength pick back up here to support this market if it's going to continue to move higher in the short term. And again, now these are short-term indications. This doesn't have anything to do with long-term, but in the short term, if we can improve relative strength, flip this buy signal, this sell signal back into a buy, this market can continue to move higher, at least for now. The question, though, becomes ultimately, this market's going to have to correct itself at some point. But again, that's always kind of the hard part to determine is the timing. You're going to get a correction of 5 to 10%. We've talked about this before. The problem is just the timing of it. And again, if we go back to last year, this time, really, if you'll remember in March, April, May, and March of last year, we had the Silicon Valley Bank crisis. Markets stumbled, and then we had the AI chase in April, May, June, and July. So 4 months, that market rallied fairly strongly. We were up about 16% in the first half of 2023. Then we had a 10% correction. So very similar to that rally, we've had November, December, January, February. So 4 months of this rally, just like we saw last year, same type of magnitude of the rally as we saw last year. Will this ultimately end another 5 to 10% correction? Probably. And 5% corrections happen on average every year. 10% corrections happen every 1.5 years. So again, we're well within the time frame and both of extensions of the markets, et cetera, that you're going to get a correction. But for now, again, all you have to do is watch this 20-day moving average. That's your indicator, most likely, that we're going to start a correction. As long as we can continue to sustain this, portfolio allocations are fine. All right, that's what you need to know before the bell this morning. We'll come back. We'll pick up with Michael Leibowitz. We'll talk about the Fed, the Magnificent Seven. Is it in a bubble? We got it all for you this morning. Don't go away. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. If the Valentine's Day glow has faded, promise you'll respect your lover's credit. Communicate about your money and share together our first candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratcliffe will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratcliffe and Rosso. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning. Can you back off a little bit? Gotcha. I know. You're right in my face. You're all up in my face. All up in my grill this morning. All right.
Couple of things going on. Let's start. I know y'all want to get to Nvidia. We're going to get to that. We'll talk about the Magnificent Seven. Let's start a little bit with the Fed, though, because, again, that's going to be driving interest rate policy. Couple of things that are going on here that I think are key. And these are going to be key to the markets as well. So, while the markets are doing fine right now, again, nothing wrong with the markets. No reason to be bearish on markets at the moment. When that occurs, we'll certainly help you with that. But there are some things out there that are going on, particularly with the Federal Reserve, that are interesting. And again, yesterday was the release of the FOMC minutes, and there were some interesting statements in those FOMC minutes that the markets, really didn't pay much attention to yesterday, and certainly aren't paying attention to them today. But one of those was talking about future rate cuts, because, again, the markets are continuing to kind of bank on this idea that the Fed's going to cut somewhere 5 to 7 times this year. And we've talked about for a while is that the markets and the Fed are going to have to come into alignment at some point. So either the Fed's going to have to become more aggressive about cutting rates, or the market's going to have to give up on this idea of as many rate cuts. And this was one of the statements. And so talking about that specifically in the minutes yesterday was this statement. Participants generally noted that they did not expect it would be appropriate to reduce the target range for the Fed funds rate until they had gained greater confidence that inflation was moving sustainably towards 2%. Most participants noted the risk of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing incoming data to judge whether inflation is moving towards 2%. Now, here's the interesting point about that, is that if you take a look at core inflation, and again, Mike and I talk about it, the inflation reports, we read articles about this, but CPI was a lot hotter than expected last month, and that was because of shelter. But even in the core, we're seeing some of the core pressures of inflation rising again. Now, some of this has base effects in it. Some of it is simply the function of supply and demand of the economy. The economy is doing just fine now. And so we're seeing inflation tick up, but there's not immediate evidence that inflation's falling towards 2% from the Fed measures. And I want to emphasize that, because when I turn this over to Mike here in a second, he's going to bring up the Trueflation Index that shows 1.8% inflation. But anyway, Mike, your thoughts about the notes yesterday?
First of all, I commend the Fed. I think they're doing the right thing. And, we've talked about this numerous times. Why cut rates when you don't have to? So they just want to make sure that inflation is getting back to their target. And that's their goal. That's been their goal all along. So, we've been kind of surprised the markets, especially when the market is pricing in 7 or 8 rate cuts this year. It's like, what are you pricing in? The economy is doing fine. Inflation is still above target. It's trending lower, but it's not anywhere near target, especially when you look back at the last 20 years. There were very few periods inflation was above 3%, target's 2%. So I actually commend them for trying to hold the line and just make sure that inflation gets back to where they want it to be. And right now, like you said, the last set of inflation data kind of says that inflation may be getting sticky here. And that's what Powell said at his press conference too. So that part of the FOMC, the minutes from the FOMC meeting, were not surprising. I just think they wanted to further cement that fact home with the market.
Yeah. And again, the markets really didn't pay much attention. I shouldn't say that. I shouldn't say the markets didn't pay much attention to it, because yields popped yesterday slightly right after, that announcement. So again, the bond market at least said, hey, there's, maybe we need to kind of rethink ourselves for a moment. Markets didn't really care too much. Because right after the minutes, the markets took off and were negative most of the day, and the minutes came out, and then the market runs back up into positive territory. And today we're going to be up 1.5%, 2%, depending on the index. But, if you read further into those minutes, there is a risk out there that is going unappreciated by the markets. And that is really what's going on with, reserve balances and the reverse repo. And they said this: in light of the ongoing reductions in the usage of the reverse repo facility, many participants suggested it would be appropriate to begin an in-depth discussion of balance sheet issues at the next meeting. So the next meeting is March coming up. Some participants remarked that given the uncertainty surrounding estimates of the ample level of reserves, slowing the pace of the runoff could help smooth the transition to level of reserves that could allow the committee to continue balance sheet runoff in the future. So, one of the things that's been interesting, and I posted a chart this morning on Twitter of kind of Fed liquidity, and that's been rising. We've actually 2 charts on Fed liquidity this morning. Liquidity has been rising ever since November, which is why we're seeing the markets perform so well. But at the same time, there's this issue of the balance sheet runoff. The Fed's trying to reduce, quantitative tightening. The markets are running up. Financial conditions are as easy today as they were in 2020. If you take a look at the Fed Liquidity Index, they're as easy as they were back in 2020, yet we don't have stimulus checks and everything flying around the country. So, financial conditions in terms of the markets, everything is fine. But this reverse repo facility and Fed and reserves for the banks are continuing to be under pressure. So, Mike, the question is the Fed potentially jumping the gun too soon on stopping QT, given what's going on with the markets and overall liquidity? Or are they kind of doing the right thing here?
I hate to say it again, but I'm going to commend the Fed. They're doing the right thing. They're trying to get ahead of a liquidity problem. The reverse repo was basically built up to 2.4 trillion for the purpose of absorbing excess liquidity. The Fed did so much, the government did so much to fight the pandemic, and the result was just a ton of excess liquidity. That extra liquidity is getting put back into the markets primarily to fund the Treasury right now, among other reasons. So what the Fed is anticipating is that the reverse repo program kind of heads towards zero, which it's been doing, and that is anticipated to occur sometime between March and May. And it's not that the reverse repo program goes away or goes down to a very low balance. It's that there's no more excess liquidity in the system. And that is potentially a big problem for markets. So what the Fed is saying is, look, we see this. We see this as a potential problem. And maybe we need to adjust the amount of QT we do. Because QT also drains liquidity. That's one of the main purposes of QT. The Fed is putting bonds back out on the market, essentially, takes liquidity away from other parts of the banking system, whether it's markets or loans to individuals or corporations, mortgages, whatever it may be. So the Fed is saying we have to start better managing liquidity, because we're starting to get back to that point where we were in 2019 when we had liquidity problems. And, the question is, will they know when liquidity dries up too much? Because it's not necessarily at a zero repo balance. It could occur even when there's a decent repo balance, say 300 or 400 billion. Or it may not occur till that thing has gone away and 5 months have elapsed. It's just very hard to measure true liquidity in the system, because a lot of it is just based on banks' willingness to lend and the willingness of borrowers to borrow.
No, go ahead.
No, and just the amount of leverage being demanded by the market. If the market's not demanding leverage, the need for liquidity is less than in a highly speculative market where the demand for liquidity is more. So there's a lot of factors that are impossible to calculate. But for what the Fed's doing, for what all of us can do, is we can watch that repo program and realize that that's a big chunk of liquidity that's slowly leaving the system.
So, and I guess this is my question, though, right, Mike? Because if you go back, say, we look at bank lending standards, those are starting to ease somewhat. The dollar's been very strong. So remember all those concerns a couple of years ago of, de-dollarization, the dollar's going to zero, et cetera, and the dollar's been extremely strong. So that's been dragging in foreign reserves into the country. And this is all feeding in. Interest rates have come down from where they were. So this is all feeding into overall financial conditions, which are making things much easier in the economy. And now so at the same time, the Fed's been reducing the balance sheet. underlying Fed liquidity from, the repo and other reserves and the Treasury general account balance, et cetera, those have all, but that whole liquidity side of the index has been rising. And so it seems kind of counterintuitive, the Fed saying, I need to slow the taper runoff to make sure there's liquidity in the market. But there seems to be plenty of liquidity, and particularly with financial conditions as easy as they are now, 5.5% interest rates on the Fed funds really isn't, impacting the financial structure of the markets that previously has been the case, right? Normally when the Fed's hiking rates, you're really constricting financial conditions, and it's been absolutely the opposite this time.
So let's talk about the Fed Liquidity Index, right? There's kind of three components to it. One of them is the Fed balance sheet, whether it's doing QE or QT. One is the reverse repo, and one is the Treasury balance.
I do it, but we're on a break. Hold that thought. Yeah. So hold that thought. We'll come back. We'll pick up with that. And then I want to jump because the reason I want to touch on this and these financial conditions is that we need to then flip over and talk about the Magnificent Seven and this, this very strong run up in the market that now people are back into the condition of, this is never going to stop going up, right? We're back to that kind of bullish sentiment. So we'll talk about all that coming up right after the break with Michael Leibowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. If the Valentine's Day glow has faded, promise you'll respect your lover's credit. Communicate about your money and share together our first candid coffee for 2024. 5 money habits of unhappy couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 money habits of unhappy couples. Candid coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife was panicking over the weekend because she saw this video that said 50 years of makeup. And so this girl was going to do this video about the changes in how women do makeup over the last 50 years.
The Real Investment Show podcast from your favorite service. Same show, your schedule.
And it started in 1980.
At realinvestmentadvice.com.
You just kind of thought it was going to start in the 50s, didn't you, babe?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit about, with Michael Leibowitz about liquidity and kind of what's going on, because obviously we have this can't stop, won't stop market right now. And, it's very interesting, as I said, at the opening of the show, if we go back to March of last year, we had a fairly strong start to the year in January and February, and then we kind of stumbled in March a bit over the whole concern over Silicon Valley Bank default, et cetera. And then the markets took off running for the next 4 months into July on this whole AI chase. And during that same 4-month period, it was all about AI, who was announcing AI in their earnings, Nvidia's earnings, et cetera. And we got into this attitude in the markets that this market's just going to keep going up, right? There's nothing going to stop this market from going up. I mean, I was getting emails daily. It's like, this market's just not going to stop. And I'm getting the same emails now. And, as we talked about earlier, you're going to get a correction here at some point just for the function of something, right? Probably nothing that we're talking about right now, but something will happen. It'll spook the markets. You'll get a 5 to a 10% correction, work off some of this overbought condition. But, this is all about psychology in the markets at the moment and a lot of liquidity. And again, as we talked about, as we were talking about just for the break, if you take a look at the Fed Liquidity Index, if you take a look at overall financial conditions, as I said previously, are as high as they've been since 2020. And, when we're doing all the stimulus, and a lot of this has to do with the strength of the dollar, that feeds into financial conditions. Lower interest rates feeds into financial conditions. So from the market perspective, things are great for the equity markets. And, and as Mike was just starting to address for the break, and we'll pick up there's some components in the Fed Liquidity Index that we kind of need to pay attention to. So, Michael, I'll let you start with where you left off.
Components. One is just the Fed balance sheet. And the Fed's been doing 95 billion of QT a month. So basically what that does is the Fed is taking 95 billion of treasury bonds and mortgages off their books, and they're putting it essentially onto the books of investors. So the investors have to come up with 95 billion. That drains 95 billion of liquidity every month. The second is the Treasury General Account. So the the Treasury borrows money, they put in their bank account at the Federal Reserve. Like your bank account or my bank account, it fluctuates up and down. Sometimes it's just fluctuating with the flows of the Treasury. Other times they're purposely trying to increase it or decrease it. But right now, they're purposely letting it come down a little bit to control issuance. So on the margin, that has its effect on liquidity. But the big one is this repo program. When the repo balances go up, it's taking liquidity out of the market to put into the repo program. And when it comes down, the exact opposite effect. So when we look at our gauge, the Treasury account is, we can just kind of ignore that because it's kind of going up and down, but not really. The numbers aren't big and it's not going anywhere. We know the Fed's draining 95 billion a month. And then we got the repo program, which is declining. So it's releasing liquidity to the market. And that is potentially offsetting a lot of QT. First of all, we know there's only about 500 billion left in the repo program to feed the markets with liquidity. But there's one huge missing factor, and that's the Treasury itself, who's borrowing a ton of money. And we know that those repo balances are going indirectly back to the U.S. Treasury. So, I think a better liquidity measure should also include net Treasury issuance. because they're draining liquidity when they're net borrowing more than is maturing. So, I think, yeah, it sounds like the Fed's adding liquidity through these three or four, the Fed and Treasury are adding liquidity. But when you really put the four pieces together, they are draining liquidity. And what we find out is that loan growth is actually shrinking. What's growing is investment, speculative loan growth. But real loan growth to the economy is actually shrinking, and that's what the Fed wants. They don't want a speculative environment either, but I think for all intents and purposes, liquidity is shrinking, and the Fed knows that, and that's why they want to try to manage QT along with the reverse repo program.
Yeah, and I'm getting a couple of questions in YouTube chat about where to find this Fed Liquidity Index. In fact, I just posted it this morning on Twitter. So if you go to our Twitter account at Lance Roberts, like the second or third post is the Fed Liquidity Index. So and it's matched up to the S&P, so you can kind of see what's going on. But so Mike, this when we're talking about financial conditions, we're talking about Fed liquidity, et cetera, and then again, this is all kind of translating back into a very bullish setup for the markets. Of course, Nvidia's reports last night, $22 billion in revenue, which was more in one quarter than for an entire year. A couple of years ago, this company was making like $6 billion a year in revenue. They did $22 billion in a quarter. So stock still trades at 37 times price to sales, but it's hard to deny the revenue growth. They're going to be a $2 trillion company today, probably getting very close. We're $1.6 trillion yesterday. It'd be roughly $2 trillion today. So we're about to, this has become probably the most important stock to the U.S. stock market. Again, yesterday, markets were kind of down a whole lot. One stock reports earnings. The whole market's going to be up 2% today on the Nasdaq, 1.5% on the S&P at the open. So a lot of dependence on one stock in the top 10 stocks of the market, which has been really, when you take a look at performance, the top 10 stocks have been driving the majority of the performance of the index really over the last 2 years, but even so far this year, the Magnificent Seven, the top 10, however you want to classify it, have been doing the bulk of the lifting for the overall market. If you take a look at the number of stocks above their 50-day moving average, the number of stocks above their 200-day moving average, those have actually been declining since the beginning of this year. But yet the stock market continues to lift higher on the back of these very big mega cap stocks. And so you kind of wrote an article this week asking the question that everybody's asking right now is like, are we back into a bubble?
Right. So the Nifty 50 was a set of approximately 50 stocks in the late 60s, early 70s. And these are household name stocks, your Coca-Cola, Kodak at the time, Polaroid, a bunch of stocks that everyone knew and everyone assumed that their earnings could grow much more than the economy and the market. So they had in aggregate PE, price to earning ratios that were roughly twice that of the S&P. And very different environment, but at the time it felt similar to Magnificent Seven. You have these stocks at very high valuations that were doing much better in the market. Was it a bubble? A lot of people call it the Nifty 50 bubble. So I stumbled upon an article from Jeremy Siegel. And what he basically did was say, he wrote the article, I think, in 98. So about 25, 26 years after that bubble had popped. And those stocks had fallen over 50% in aggregate in 1973, 1974. But what he did was say, okay, at the peak of the Nifty 50 bubble, put that in quotes, were the valuations fair? What should the valuation have been? So, for instance, if the market price to earning is 15 and a stock is trading at 30, that doesn't mean it's expensive. That just means the market thinks that its earnings are going to grow much faster than that of the market. So the question he posed was, did they, over the next 26 years, did their earnings grow? And in fact, their earnings grew at a rate greater than the market. And he basically backed into knowing what their earnings were for the 26 years after the bubble popped, what should their PE ratios have been? And they were right in line with where they should have been in aggregate. There were some more, some less, but in aggregate, they were fairly priced. So his conclusion, I think it's a very important conclusion because it holds for today. he said that the stocks were fairly priced. The problem was that investors lost confidence in their ability to grow at those kind of rates. So again, in the 70s, you had high inflation, recessions, in and out recessions, high unemployment, and investors assumed they couldn't grow at those kind of rates because the economy was pretty poor and inflation and a whole bunch of factors. So the question we have to ask today is, are the Magnificent Seven stocks worthy of these high valuations? So what we did was we kind of used his logic and implied growth rates. So we said, okay, over the next 10 years and over the next 26 years, because 26 years is what he used, what do earnings have to be for the stocks to perform in line with the S&P and their price to earnings to come back down to market levels? And if you read the article, you'll see the 7 stocks and the implied earnings growth. Some look reasonable, some may not be reasonable. But I think you have to look at each one and understand their situation to appreciate whether they can achieve that kind of earnings growth. And maybe what we'll find is, like in the Nifty 50, Philip Morris was dirt cheap at the time. Even though everyone thought it was in a bubble, it was dirt cheap. It ended up growing its earnings much more than was implied by the market. So my guess is we'll go through these 7 stocks, and there's a few others like Lilly, and realize, and if we look back 20 years from now or 10 years from now, yep, Nvidia may have been cheap, or Nvidia was too expensive. There's no way it would have to be the whole semiconductor market to grow its earnings at that kind of rate. Can Amazon continue to grow earnings while it's just totally taking up market share? Is there enough market share? But those are questions you have to ask of each of the 7 to really assess if it's a bubble or not.
All right, quick break. We'll come back and we'll pick up on that topic, and also just kind of talk a little bit about the Japanese Nikkei, which actually just set a new record after 34 years. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. If the Valentine's Day glow has faded, promise you'll respect your lover's credit. Communicate about your money and share together our first candid coffee for 2024. 5 money habits of unhappy couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 money habits of unhappy couples. Candid coffee with Ratliff and Rosso. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. So just really kind of finishing up on our conversation about, kind of the markets, this Magnificent Seven. And again, these kind of moves in the markets can last far longer than you can imagine. There's, John Maynard Keynes is famous for saying the markets can remain irrational longer than you can remain solvent. And that's always the case. And this is the big challenge for Mike and I and Nick in managing client portfolios here at the firm is, from a fundamental side and from our fundamental base, which is where Mike and I come from because we're old and, back in the day when there was like 4 people trading in the stock market, fundamentals mattered. And we're now to this point where fundamentals really don't seem to matter. It's all about the Fed. It's all about liquidity. It's all about interest rate cuts. It's about one stock. It's about Nvidia, right? So goes Nvidia, so goes the market. And that certainly doesn't seem to be a healthy, sustainable support for the market, right? In the near term, it can certainly be that way, but it certainly seems to be challenging if you start thinking about, longer term time frames, 2 years, 3 years, 4 years, 5 years. And that underlying all this is that it's going to be economic growth that matters. It's going to be fundamentals that matter. It's going to be corporate profit margins, which is a good example because profit margins for corporations are actually weakening, not strengthening, and yet the market's going higher. So again, it seems that at some point there's going to be a bit of a realignment between markets and fundamentals. Either the fundamentals have to catch up with the markets or the markets will catch down to the fundamentals. And there's nothing that says the fundamentals can't catch up with the market. It just normally doesn't happen. It's normally over exuberant prices catch down with the reality. And if you take a look at, kind of what's happening with retail investors, right? Retail investors are back piling into some of the riskiest assets. The meme stocks are back. And that ended badly last time. And it'll probably end badly this time. But again, in the middle of the fury, right? And in the middle of the hype, markets can keep going up. And this is what makes it a challenge. I mean, yes, we own Nvidia, we own AMD, we own Microsoft, we own Amazon, we own Apple. We own these companies, we own Google because that's what's driving markets. We have to create portfolio performance for our clients. But at the same time, we have to manage that risk. And that becomes the challenge, right? That's the hardest part about managing a portfolio in today's environment is maintaining some type of risk controls in an environment that doesn't reward you for managing risk. And that's something we just have to deal with. And so to that conversation, I find it very interesting, Mike, is that after 34 years, the Nikkei just hit an all-time record high. So it took 34 years. It's the longest period that some people can find. Actually, there was a longer period going back from 1929 to 1954. But it's been a very long time for Japan to be technically in a secular bear market. It's been a 34-year bear market, finally ended with this breakout to a new high yesterday. Interestingly, though, this week, Japan just entered into a recession. So foreign investors are piling in to the Japanese stock market to chase prices higher. At the same time, the economy just entered into a recession, which seems a bit hard to kind of justify. Mike, your thoughts?
Look, it's kind of funny. I graduated college in 1990. Had I put my money into the Nikkei at that time, put some money into the Nikkei, I'd finally be getting it back today.
Yeah.
They were in a bubble of epic proportions prior to 1989, and it popped. And they didn't let it pop fully. They dragged it out over decades. Literally, it's called lost decades. To help appreciate, a lot of it was both stock-based and primarily real estate-based bubbles. The Emperor's Palace, I believe it's in Tokyo, I think it's 280 acres. At one point, at the peak of the bubble, it was said that that was worth more than the entire state of California. It's just insane what was going on with property values. And then those properties were used as leverage so investors could buy more properties. So there was a whole domino effect. And, as we see with bubbles, eventually they get popped. And because of the way Japan handled their bubble, it took them 35 years. Well, it took 35 years for the Nikkei to recover. GDP still hasn't fully recovered.
Right.
So, but what's hard with markets, with what we do is we have a really good sense of macroeconomics, what's going on in the world. We have a good sense of what's going on in the market, right? And at times they're very much in unison. Other times they're not. So, what you have is a market that's going up in Japan. And investors, not just in Japan, but around the world, see that occurring. And they're jumping onto that bandwagon. Now, you also have to remember that as part of this bubble cleanup that's been going on 35 years, the Bank of Japan has not only been buying bonds like the Federal Reserve, they've been buying stock ETFs. So I think they own, you could correct me here, Lance, don't they own like 60 or 70% of all stocks?
You might want to try you might want to try 80 now.
80%.
Yeah.
So the point is, like the price of anything, supply and demand matter. So the supply of stocks is not that great in Japan. The demand doesn't take a huge increase in demand when you have so little supply to push the stock prices higher. And
well, again,
it's a long story.
Right, but that's my question though, is that you take a look at the Japanese economy. Good example. The economy has rolling recessions about every 3 to 4 years. Just went back into a recession. Interest rates have to be manipulated by the Japanese government because they can't afford a big push in interest rates. So interest rates remain near 1% in Japan. You take a look at the average Japanese citizen, they tough time getting employment, tough time getting ends meet. A lot of the Japanese youth won't get married and won't leave home because there's no opportunity for them. And so, when you take a look at what's underneath the surface of the market, it's very weak economic activity, yet you have a market running up very similar to what we saw prior to 1980 on this expectation that the Bank of Japan is going to continue to buy their ETFs, continue to buy the bonds, continue to do yield curve control. And that's not a functional market that can remain long term. And again, this at some point the Bank of Japan is going to own 100% of the stock market, 100% of the bond market. How does that function? You don't have functioning of a market at that point. So, are investors setting themselves up again for another very disappointing outcome by chasing the Nikkei higher here?
Well, it's important to remember that Japan is a big exporter too. So it's not just about their economy. Like we talked about Toyota last week. Mm-hmm. Toyota is the world's largest car automaker, right? So when you're evaluating Japan stocks like Toyota, you're really valuing the global market for cars. I'm sure Toyota sells a lot more cars in the U.S. than in Japan. So the U.S. economy probably matters more to Toyota than Japan's economy. So that's, one thing to consider. But yeah, this is how bubbles start when valuations and prices rise much quicker than the economy. And they're fostered at times, and it seems like more recently, much more so by Federal Reserve or central bank actions that fool around with the supply and demand of assets in the market. This goes back to liquidity. They're changing the liquidity in the markets and pushing more money effectively, not directly, but effectively pushing more money into certain assets. It was real estate back in the 80s. Is there a bubble going on in Japan now? I wouldn't call it a bubble, but there's certainly stocks are getting a little frothy compared to the size of, but compared to Japan's problems. They have a massive demographic problem too. They're shrinking.
Yeah, and that's my point.
And me and you would be young in Japan.
Exactly.
That's where we should move to.
No, exactly. But no, that's my whole point, though, is that we're seeing this replication of what happened kind of in the 90s, just in a different form today. And again, but we see this everywhere. This financialization of the markets. This interconnectivity between markets and central banks. And these markets are being driven more and more by central bank activity more than anything else. And so it certainly seems problematic to maintain that type of narrative long term. Again, there's these periods of time like now that markets are ignoring fundamentals. And economics, again, Japan's a good example. Japan's hitting an all-time high. It's gone completely vertical. It's up 24% just year to date in the Nikkei. So if you'd invested January the 1st in the Nikkei, you'd be up 24% on your money just since January, yet the economy's in a recession. That doesn't really seem to make sense, but it is what it is right now.
And, keep in mind, their price-earnings ratio is only about 16 or 17.
Right.
Ours is, 24, 25, whatever it is?
Well, it depends on how you measure it, yeah.
Right. So it is not, I wouldn't call it a bubble yet, but it's something to keep an eye on.
Yeah. No, absolutely. All right, that wraps up the show for the day. Of course, as always, get by the website. Michael's latest article on the website now, talking about the Magnificent Seven. It was posted out yesterday. It's on the website, realinvestmentadvice.com, along with our daily market commentary that's out this morning, as well as our weekly newsletter out this weekend. This weekend's topic, the Conference Board just gave up their recession call, even though their leading economic indicators suggest a recession's coming. That's where we are. It's all on the website, realinvestmentadvice.com. Have a great day. Richard Rosso, Danny Ratliff with you in the morning. We'll see you then.